Google just dropped its Q1 2025 earnings, and let me tell you, it's not just about the numbers, which were good, it's also about the narrative. From AI breakthroughs to new monetization plays, this earnings report was stacked. But we're not just here to read the headlines, we're here to break it down so you can understand what matters and how to trade it. Let's start with how Google's rewarding its shareholders. They just raised their dividend again, up 5% to 21 cents per share. It's a small bump, but the message is big. Confident in free cash flow, confident in the long game, and they know investors are looking for stable returns in an unstable market. Right behind that, a $70 billion buyback. That's massive. That's not just financial engineering, it's a strategic signal. When a company buys that much of its own stock, they're telling you they think it's undervalued and they'd rather invest in themselves than anything else right now. Google reported $90.2 billion in revenue for Q1, up 12% year over year. Net income came in at $34.5 billion, which is a 46% jump. EPS landed at $2.81, beating expectations. So yeah, strong growth, strong margins, and they did it while navigating a messy macro market with the Trump tariffs. But what really matters this quarter isn't just what they made, but how they made it. Let's start with AI. Gemini 2.5 just dropped and is already being called their most advanced model yet, especially in reasoning, multi-step logic, and coding ability. Meanwhile, AI overviews, those new AI-driven summaries in Google Search, are now reaching 1.5 billion users a month. That is a real-time, at-scale rollout of AI embedded directly into their core product. Google's Waymo is also quietly stepping it up. Right now, they're delivering over 250,000 paid rides per week across 4 US cities. And there was a little tease dropped about the possibility of users owning Waymo vehicles in the future, not just riding in them. That's a shift from service to product. And if it happens, it's a big one. Let's break down some of its core business segments. Google Cloud just brought in $12.3 billion. That's up 28%, and a lot of the growth is being driven by demand for AI infrastructure. So again, AI isn't just a cool talking point, it's a revenue engine for Google. Search and other ads brought in $50.7 billion, still their biggest driver, and that's a 10% year-over-year increase. So even with all the AI noise, the old moneymaker is still doing what it's supposed to do. YouTube ads, YouTube being owned by Google, came in at $8.9 billion, also up around 10%. And that's while TikTok is still eating attention spans for breakfast, YouTube is holding its ground. And here's something that doesn't get talked about enough: subscriptions and devices. Between YouTube Premium, Google One, and other services, they've now passed 270 million paid subs. That's recurring revenue, that's leverage. But let's not pretend it's all perfect. Google is still in the regulatory spotlight. They're facing antitrust heat here in the US, and depending on how those lawsuits play out, they could be forced to divest or restructure parts of their ad and browser business. The words monopoly and Chrome, that's not noise, that's real risk. There's also growing pressure globally from the EU's Digital Markets Act to rising tariffs and trade barriers in key markets. So what does this all mean for investors? It means Google is executing, they're growing, they're monetizing AI in real time, but they're not invincible and risks are not imaginary. That's why SwingingBull laid out 2 key levels for traders watching this. Bullish above $165 with a target at $170. That's if momentum holds and we break into post-earnings strength. But bearish below $160 with downside to $155, especially if we see weakness off macro headlines or regulatory escalation. Make sure to join our free Discord and get access to trading alerts, education, and more. See you there.